We've seen this explosion of AI sales tools. How do you advise SaaS founders?
Get out there and know you're playing musical chairs, and when the music stops, you're either going to be a player or not.
This is Dave Kellogg. He is the executive in residence at Balderton Capital and one of the best SaaS expert and strategic advisor in the field.
The low-hanging fruit on efficient growth is a dispassionate, calm analysis of what sectors do we sell to. There's a lot of just good old-fashioned analytics, and so much of SaaS success is based on this, Harry. You just have to ask the question, what's working, and then double down.
What worries you most in SaaS today?
Subscription pricing.
Why?
Because I think...
Dave, I am so excited for this. I always learn so much from our discussions. I got so many messages from our last show years ago from people who literally stopped to take notes, which I think is probably one of the biggest compliments a podcaster can get. So thank you for joining me once again.
Well, it's great to be here, Harry, and it's great to see you again, and congrats on all the success.
It's so kind. It's so lovely to see you again. I do want to ask, for those that do not know the Dave Kellogg brand, what would you say is the career highlight, what you're best known for to date?
Sure. I'm probably best known for one of two things. Operationally, being the CMO of Business Objects for 9 years as we grew from 30 million in revenue to $1 billion in revenue. Not market cap, but revenue. And from 240 people to over 4,500 people. So that was probably my biggest operating accomplishment. I mean, I have run two companies, one from 0 to 80 million after that, and I've run another one from 8 to 50 and sold it. But the biggest one has got to be the Business Objects run.
I mean, I love that clarification of revenue, not market cap as well. Important in all markets. Knowing all you know now, before we dive in, what do you know now that you wish you'd known when you started your career in SaaS?
Well, it's a tough question, Harry. For me, I'm not sure how applicable this is going to be to everyone in the audience, but power. I never really understood power. If I could go back in time 20 years and just say one word to myself, it would be understand the power structure of corporations. Because I tend to be a call it as I see it always kind of person with kind of blatant disregard for power structure. And that has got me in trouble over the years.
That's so interesting. Why is it important to understand? Because I'm the same as you. I'm incredibly direct. I always think, it's better to be clear and direct up front. Can you unpack the importance of understanding power, just so I understand it?
I think for me, Harry, it was, because I'm something of an idealist. I always thought that kind of being right would win in the end. Like if you had the best argument, you would win always. And by the way, I'm a pretty good arguer and I won a lot, but it's not always the case, right? Sometimes you need to, and this, by the way, is what I spent most of my career in marketing, not sales, right? The first time I had a quota, I was a CEO, right? I know a lot about sales, as we'll talk about, spent a lot of time supporting them, but let's be clear, I come at it from the marketing perspective. And I think the difference between a salesperson and a marketing person is I tended to be more theoretical, what is correct, what is right, whereas a seller is reading the room very closely. Who cares about what, who has what interests? So I had some famous board conflicts. I mean, Bernard probably should have fired me at least 4 times at Business Objects. I would have fired me in hindsight. So yeah.
I love that. Listen, I want to start on where we're at today. Everyone seems in SaaS to be saying, well, budgets are all centralizing. They're going back to the CFO, and the CFO is not buying. I'd love to understand, how do you think about efficient growth and what it really means to you today?
So certainly it's tougher now than it's been with the CFO doing their best to keep budgets under control. I think for a SaaS company, efficient growth, to me, it ultimately means, I'm a metrics person, you know that. We got to look at our CAC and our CAC payback period and see how much we're paying for $1 of growth. And the easiest way to do that is to go understand what's working. There's a lot of other ways we can do experiments, but the low-hanging fruit on efficient growth is a dispassionate, calm analysis of what sectors do we sell to with the higher win rate, with the faster sales cycle, with the better ASP, with the higher NRR. There's a lot of just good old-fashioned analytics you can do to say what's working. And so much of SaaS success is based on this, Harry. You just have to ask the question, what's working, and then double down.
Okay, question. How do you know when you have enough data to know what's working? Like if you have $1 million in ARR, you work with, say, Balderton, who invested at Series A. A lot of Series A's are pegged at like $1 million in ARR. Is that enough data to know what's working, or is it 10 million? Can it be 100K ARR? When is that point of I have enough to know?
Yeah, one of the reasons I like working with smaller companies is it's a mix of art and science. Because by the time we're 300 million or 500 million, it's just a math problem. but when you're 1 million, it's very difficult. So to me, I mean, my line, one day I'll do a blog post on this, is an ICP, Ideal Customer Profile. ICP starts out as an aspiration, and over time it becomes a regression, right? And what does that mean, right? It means in day one, it's an aspiration. We want to sell to companies who look like this. We think this buyer will buy us to solve this problem, right? It's a company buyer problem. That's the aspirational phase of the ICP. And by the time you're, 100 million in ARR, it's a regression, right? We just look and say, okay, who expands the most, who sells the fastest, who has the highest win rate, right? So you're along that continuum.
I totally get that. Can I ask, what should founders be looking to achieve to know if they have that efficient growth? When you look at that segment of the audience, what should they be looking to achieve to know they have efficient growth versus not efficient growth? You said that like you want to know what's working.
Yeah.
Are there glaring signs of not efficient growth?
Sure. I mean, let me do the glaring signs of not efficient growth first, like a CAC payback period of over 24 months, maybe over 36 months, where at some point VCs won't call you back. That was always my joke. If you talk to a VC and you say, hey, my CAC payback period is 36 months, it's so nice to meet you, Harry.
But does that matter? Okay, I'm just pushing you. Does that matter if your LTV is 8 years?
Well, darn, you beat me to it, Harry. Yes, that's going to be the question, which is what you pay for something should be a function of what it's worth. Right? It's that simple. So I don't love it. That's why I was trying to pick kind of an egregiously high CAC where it's high enough that at some point in 36 months, I might not actually care what your LTV is. I mean, I do know companies. I just talked to one yesterday that does like 10-year contracts with big insurance companies. Okay. So they might be an exception, right? Because all their customers seem to last 10 years. But the answer is very much what you pay should be a function of what it's worth. And therefore, I can't make a hard and fast rule. I do think somewhere around 24 to 36 months, people stop calling you back. So you have a different problem, right? It doesn't matter how good your story is if you don't get the meeting.
Does the good payback period depend on the ACV size? And so if you are selling, 100K ACVs, it should be a much smaller payback or shorter payback than if you have longer ACVs, or is it actually pretty much the same?
So I think CAC payback, to be clear, CAC payback is not my particular favorite metric here. I like the CAC ratio the best. I know a lot of VCs are very focused on CPP. I like CAC ratio because it's simpler.
What's CAC ratio for
sure,
me?
CAC ratio is just sales and marketing expense divided by new ARR. So in English, it answers the question, how much do you spend to pour $1 of ARR in the bucket? So in my mind, it's the purest measure of sales efficiency because VCs, God bless you all, tend to like compound metrics because you're in screening mode, right? And in screening mode, CAC payback period's 48 months. I don't need to meet these people, and I don't care why, right? Right? It's a great screening metric, but if you're actually trying to fix things, right, I want to look more granularly. So CAC ratio does not include gross margin, for example. If I want to know what your gross margin is, I can ask you what your gross margin is. Whereas if I just want to know, what do you spend to put $1 in the bucket? Without asking what happens to it once it's in, that's the CAC ratio.
Can I ask you, you said that the sales and marketing, divided by the, net new revenue, you can always fudge numbers. We see numbers get fudged a lot. Is there a way to fudge the numbers that you put in terms of those sales and marketing? Well, that one doesn't count because of X. Or actually, for founders trying to understand this, is it a very simple one?
Yeah, well, first, the other reason I like simpler metrics is there's less to fudge. Let's be clear. So you're going to find me a big fan of simple, basic metrics because there's fewer kind of cheat dimensions. I could cheat, on CAC ratio. I mean, popular hacks include excluding the cost of customer success. Another popular hack is using GAAP sales commissions, which get amortized, which are going to understate sales commissions, so they really should be done on a cash basis.
So you should include sales commissions and customer success in that sales and marketing CAC ratio.
Correct, and you shouldn't amortize the sales commissions. You should, I can't remember the term for them, but not capitalize them, expense them, do them on a cash basis. Probably the best way to say it, right? Because in SaaS now with ASC 606 in the US, you spread them out over the life of the contract, which kind of greatly understates them.
What's a good CAC ratio then?
I'd say 1.5 or less is in enterprise. I mean, here we are back to your question. The bigger the deals, the more permission you have. So in enterprise, I might go 1.5. In SMB, I might go 1.0. And the presumption there is that enterprise has bigger deals, longer lifetimes. and that SMB flips faster so you can afford to pay less.
And the joys of being a VC like I am today, Dave, is I can ask really stupid questions, and it's kind of my prerogative. What is CAC 10 or 15? That means, sorry, that for every $1 in, you get 5 out? That means...
So a CAC ratio of 1 means you spend $1 in sales and marketing, put $1 of ARR in the bucket. Now, you did a little sleight of hand on me a minute ago. I didn't want to raise it. You said net new ARR, and you've definitely transitioned to VC, because as a VC, that's what you care about. You care about how much do I spend to make the water go up by $1 in the bucket. As an operator, I actually just do it on new ARR. My first order CAC is just, it's not net new, because net new introduced churn. You just made my metric more complicated, right? You made it easier to cheat. You took away some of its meaning. It's what you care about as an investor. I did a talk once, Harry, I can't remember where, but it was on operator versus investor view of metrics. And I get why the investors look at what they look at. But if you want to know what I'm spending to put $1 in the bucket, I should just do new ARR, not net new. Because now net new is now bringing into question what happens to ARR once it's in. And if you want to know sales and marketing efficiency, right? You didn't ask about kind of overall productivity or business building productivity.
I get you, but for someone who wants to understand the trajectory and health of the business, net new is better, no? Because new, I could be adding 1 and losing 10. Be a bad investment.
Yeah, you're definitely a VC, Harry. Yeah, it is, because you want to understand the health of the business. I want to know if sales and marketing is broken, and just say it's a crappy product. I might be able to pour water in the bucket for 80 cents. Right? I may have fantastic CAC ratio, but horrific churn or horrific gross margins, and that's going to show up in other metrics. It'll show up in CAC payback period. It would show up in net new CAC. By the way, you calculate new ARR CAC or net new ARR CAC. There's a lot of ways to see it, but I like what I call atomic metrics, because I'm looking at one thing. It's harder to cheat. I know exactly what I'm looking at, and if I have a different question, I'll ask the different question.
Can I ask, what other ways do investors kind of bastardize metrics? You mentioned it there, but the most common that you see, again, I want to be the best investor I can be, Dave. Like, really teach me. That's why I love my job.
Yeah, I mean, we've stumbled into my favorite example, which is CAC payback period. It's a compound metric that, if done on a net new ARR basis, it's looking at gross margins, it's looking at sales and marketing efficiency, it's looking at churn. Right, it's looking at everything. So it's a great screening metric. Don't get me wrong, Harry. If I were screening companies, I tend to want to use compound metrics. The more I'm trying to fix broken things, the more I want atomic metrics. The CAC ratio is another one. We hit it, but the purest form to me is just how much is it for $1 of new ARR. You can do it on a gross margin basis. You can do it on a net new ARR basis.
Do CACs get better or worse over time? I'm constantly struck by this, because you can think in the early days, actually, it's cheaper to acquire them because they're the most aligned customers to your product. They feel the need the most. But then you can also think, actually, over time, they get cheaper because you have brand marketing, word of mouth, virality. From your experience, do CACs go up or down over time?
So my experience, they should go down. Startups have this tendency to believe in what I would call the low-hanging fruit problem, which is, oh darn, the CAC has to go up over time because we picked all the low-hanging fruit. All the easy customers, we found them. And there are fewer competitors on the search terms that we pay for. And look, some of this is true. I'm not going to deny that. But I think most startups, when they make that argument to me, I think they're vastly underestimating the size of their market. That if you have a really, really big market, that you haven't picked all the low-hanging fruit. So I personally think it's kind of a cop-out. But the guy will accept that as a problem. If somebody's CAC is going up and they say they picked all the low-hanging fruit, I will eventually accept it, but not in the first round. I'm going to say, show me that, show me the data, show me why you believe that, because you're a $5 million company and it's a 10,000-foot tree. and I just don't believe it. So I tend to be contrarian.
I have to ask, you said about NRR earlier.
Yeah.
For those that don't know, can you explain NRR before we dive into this?
Sure. NRR, net retention rate, it's a metric that measures, in my mind, what happens to ARR once it's in the bucket. So CAC is how much does it cost to pour stuff in the bucket. Churn is how fast the stuff leak out of the bucket. NRR is what happens once it's in the bucket. The way you calculate it, typically, and this is going to get controversial, but in my mind, the official definition by Dave Kellogg's official term is basically take a set of customers from 1 year ago, take their ARR a year ago, put that on bottom, take their ARR today, put it on top, divide the two, and that's NRR.
Got you. Okay. You said before, though, that actually we need to focus on GRR also. And I was like, again, as an investor, I'm trained on NRR. What is GRR and why should we focus a lot on this also?
Sure. So GRR is gross retention rate, and it's basically NRR before expansion. So if we go back and take that year ago cohort of customers and we put that at the bottom, their ARR value, but on top, rather than putting their current value in their current value, just boom, what it is today, you exclude expansion. So you're only counting shrinkage. So the theoretical maximum GRR is 100%. NRR varies anywhere from 105 to 120 up to kind of snowflake levels at 160. But GRR usually varies between, I'd say, 70 and 100, 80 and 100. But theoretically can never be greater than 100.
So what's good NRR in your mind and what's good GRR, just so we have a benchmark?
Yeah, this has changed. So if you'd asked me 2 years ago, I would have said 120. If you want to have an NRR that people go, yeah, that's good, 120 would have been it. I think it's closer to 108 today, if I had to just pick a number. It's come down.
108?
Yeah, 108, 105. I want to see 105 to 108 in that range is what I see. It's regrettable.
That's because the increased churn levels we've seen with buyers.
Yeah, it's because of the downturn. Most of that is driven by increased shrinkage. Yeah.
Is that increased churn or is that lack of expansion?
I think it's increased churn most of the time. When I look at companies, it's usually increased churn. That they're still expanding reasonably well. I mean, I've seen companies where it's both. And by the way, if you asked, like the most recent study, I think said 105. The reason I said 108 is I just can't make my mouth say 105. but I think it may have come down from 120 to 105, to be honest. And I think it's through a mix of increased churn and decreased expansion. And I think increased churn is leading the list.
Yeah. Are we seeing the changing structure of SaaS companies today? Because I spoke to Henry Schuck at Zoom Info, and he was like, before, everyone used to come back and just upsell and expand their seats. Now, not only are they not upselling, we're fighting to keep them as customers. And so we're having to create basically data teams to prove the value that we're providing, just to keep them as customers. Are you seeing incredible pressure to prove value for existing vendors? And are we seeing changing structure of SaaS teams to prove that value?
Absolutely. I mean, CFOs are trying to reduce SaaS spend, right? I mean, SaaS spend ended up being kind of a sprawl. That there are now, I would say there are now vendors whose mission is to drive your churn, right? They're kind of SaaS spend rationalization vendors. So yes, it's a short answer. Renewals are not a given. Getting 4 or 5% increase, not a given. I mean, you're lucky to get 95. You're lucky to get 95 to 100 cents on a dollar order, right? They're trying to cut their budget, right? Not grow it. So that pressure does show up in renewals. Not surprised at all. He talked about creating data teams to prove value because these renewals are not easy to get. People are doing rebids. He didn't mention that, but they'll just bake you off and say, hey, we've decided to rebid the work. So you guys are a nice vendor and there's some switching costs leaving you, but we're doing an evaluation. And one of your competitors will do this deal for 80 units a year and you're charging 100. Right. And you may have to cut your price to 90 to keep that customer.
What are the best customer success teams that you see today doing to manage in what is an incredibly turbulent and stressful time?
I mean, first, they're not getting slooped or blown up. So if you're not careful, right? I mean, let me go back a little bit. A lot of CS teams forgot what their job was, and those people are getting blown up. That they decided their job.
How did they forget what their job was, Dave?
I've seen this happen to companies, and it's just painful. That somehow they decide they're in the customer satisfaction business and the customer love business, and they end up kind of hand holders, grief counselors. They end up just being the customer's kind of hug buddy. Like, oh, things aren't going well, give me a hug, and I'll talk to you about your problems. And that doesn't work, right? There's no value out there. Sometimes they end up being advanced tech support, which adds value. But the question is, should we just create a premium support package and sell that, right? Should it kind of be free? But sometimes it ends up salesy. To me, there's three roles. There's kind of the huggers who just give you a hug and can't really do anything other than commiserate. There's the tech support people who probably should be premium support package. And then there's the sellers who basically, I like to define customer success by how you introduce yourself to the customer. And I think the best introduction is, my name is Dave. I'm your account manager. My job is to get your renewal and grow your account. And anything I need to do that, please let me know. I'll be doing quarterly health checks and I'll be checking in. But my job is basically, I'm going to be asking you for money.
Do you think we should get rid of CS teams? And the reason I say that is because I sat Chris Degnan on the show, who's the CRO at Snowflake and has been since day one. He said, I got rid of CS because, as you said, technical support is very valuable, but we have that in professional services.
Yep.
So if huggers are not useful and the others should be professional services, is there a room for CS in modern SaaS companies?
Yeah, personally, I think there is. I think, look, if you do $100K, $500K, $1 million deals, and you have big accounts and grow them, then maybe not. Then maybe you can push it back to sales, right? Because I've worked at companies where I ran Logic. I had a rep that had one account. They're an $80 million company. They had one account, NSA, and their job was to grow NSA, right? When my first sales call at Salesforce, I went to Qualcomm. The rep, one account, Qualcomm. My job is to grow Qualcomm. So when you're doing real enterprise, I don't think if you have one account that you need to CSM. Right. You can do that on your own. So the less you look like that, the more I think you need CS. So I think CS should exist. I'm a big believer in CS. I just think it needs to understand that it's a selling role. I'm going to ask you for money. My job is to get your renewal. So I want to talk about that. And if you have tech support question, I'll connect you. Right. If you need professional services, I'll connect you.
Should you be that upfront? And does that not add an element of transactionalism to what you want to be a trusted relationship of alignment?
I think it is a trust. I mean, personally, I would be potentially contrarian here, Harry, but I think the most honest thing you can do is tell people what your job is and how you're measured.
Totally, but then you're not necessarily aligned because you want to squeeze every dollar out of me and upsell me as much as possible, and that may not be in my interests always. Like, you will try and sell me more seats than I maybe need.
Well, it's a good point, Harry, actually, because I want to argue. In my self-introduction, we can go listen to the tape, but hopefully I said my job is to get your renewal and to expand you. My primary job is to get your renewal. So I'm actually not here to upsell the heck out of you. In my mind, the upsell should be split across sales and CS. And I've got a portfolio of you, so I don't need all of you to expand at 120%. I need some of you to expand a lot and some of you just to stay on as customers, right? So, in fact, I don't think the mission is to squeeze every penny out of the customer. I think the mission is keep the customer happy, get them renewing, and spot upsell opportunities. So to me, it's slightly different.
What do you mean when you say the upsell should be split between sales and CS? Because normally it's put in one bucket, for sure. It's either sales or CS.
Yeah, and in my mind, and this is, again, kind of a minority viewpoint, but I just think that creates a lot of unnecessary conflict because as soon as you do that, now they're fighting over whose order it is. And let me just give you, there's what I call a fries with your burger upsell, right? Anybody could do it. Harry, do you want fries with your burger? Right? You go, yeah. Right? Do you want 5 more seats? Hey, we got this add-on product. Let the CS person do that. Why am I taking a $300K a year enterprise seller and having them do that order? And so my answer is if you credit both of them on the upsell, and the math will work, we can go through it if you want to, but the math works, that you can credit both of them. And that way the work flows where it needs to work, it needs to be done. So if I'm the enterprise seller and I care about my productivity and I've got a CSM who I trust, and there's some fries with your burger, hey, go ahead and get that one. By the way, more importantly, and conversely, say there's a cross-sell, and it's not looking like fries with your burger. It's looking like selling, like, for example, Host Analytics. We sold planning and consolidation. Consolidation sold to a different buyer. Same boss, same CFO, different buyer, different competitors, right? If I'm the CSM and I find a consolidation opportunity, I should call my seller and say, I found a cross-sell of the consolidation module. Can you please do this? And I don't want to incent, right? The single biggest sin in SaaS is putting your farmer against someone else's hunter, right? Because they will lose.
What do you mean by your farmer against someone else's hunter?
Sorry. So a lot of people use the SaaS analogy of hunters and farmers, that the salespeople are the hunters. They go out and kind of kill new accounts. They're very aggressive, right? They're bringing food back, for the other people to eat. And the farmers are the CSMs. That they've kind of just farm the land and keep the accounts and keep them warm and nice. And it's not a bad metaphor. And all I'm saying is you don't want to put your farmer against someone else's hunter, right? I.e., do you want your CSM trying to sell that consolidation deal against a one-stream rep who sells consolidation for a living who's really good? Your person will probably lose. In sports, they always talk about a mismatch, right? You always try to tee up. It's the same thing. We've got a mismatch here. We've put an enterprise rep up against a CSM. So get the ball to the enterprise rep because she's going to win.
I always think about that. I think it's Charlie Munger or Warren Buffett. One of the two said, show me the incentive and I'll show you the outcome. What's the right incentive structure for CSM teams today, do you think?
Yeah, it makes it difficult, Harry, because my thinking resolves a lot of conflict. It makes that question somewhat difficult. I think the right incentive is to give them a portfolio and say, I want this portfolio to be worth 105 units. It was worth 100 in the day. I handed it to you. I want it to be worth 105 or 110 a year from now. And how you get that is up to you. How you spend the time is up to you. And you get to use the sales rep because they're going to pay you both on any expansion. So if you need help, you ask for it.
Can I, as a founder today, when we think about CS teams and expectations of them, how do we approach churn analysis? And what I mean by that is, like, similar to sales forecasting, churn forecasting is really hard right now. How can I think about churn forecasting accurately and plan ahead of time?
Churn forecasting to me is actually easier than new sales forecasting. I think new sales forecasting is really hard because you're in a bake-off against multiple people. If they're a sophisticated buyer, they're deliberately denying you information. They're not going to tell you in the first place because they want to negotiate the best price, right? In an enterprise, there's a lot of different constituents. No one may actually even know who's winning, right? Because the VP of sales wants this, the VP of finance wants that, CFO wants this, there's a committee, right? So I think the hardest thing is new sales forecasting, which we can talk about if you want. I think churn forecasting is relatively easy. Why? First, because you can look at product usage data. Right. So you have a massive advantage in terms of data, right? Like, are they using the thing? Is the usage going up or down? Can I see anything in the usage pattern? Are they dumping a lot of data out of the system? Right. Are there any signs that they're actually spinning up one of my competitors in the background? Right. Which you could find. You also have relationships. And usually if you're a good CSM, part of that job, I've been honest with you about my role, be honest with me. Are you guys thinking about switching? Are you spinning up an eval? Right. So I just think CS for it. If a VP of sales misses their forecast, I'm somewhat understanding. To me, I'm not very sympathetic to a VP of CS who misses their forecast, because how is it that you didn't know? I mean, you better show us a record of the customer absolutely lying to you, like a bunch of emails saying, we're going to renew, and then they don't. And if you have that paper trail, then okay, I guess you were really misled. But otherwise, I just don't think it's as hard.
So if churn forecasting is actually more science and there's data that makes it very evident, how do you think about sales forecasting? Because this is a hard one in 2024. How do you think about sales forecasting and an advice to sales leaders approaching it today with 2024 ahead?
Triangulate. If I had one word, it would be triangulate. And what does that mean? It means, like, if you're lost in the woods, right, you say, oh, there's a mountain this way, there's a mountain that way, right? You're taking shots to try and figure out where you are. You can do the same thing with sales forecasting. What do I mean concretely? First, make your own official forecast, which you will make. Then look at the sum of your managers, look at the sum of your VPs, look at the sum of the reps, look at the stage weighted expected value, look at the forecast category weighted expected value, look at the week 7 conversion rate if you're in week 7. There's so many numbers you can look at, and you should try to view each number as an independent shot as to where you are. This also has implications, by the way, on operations, because if a sales manager tells a rep what their forecast is, you're undermining this process. I'd like a rep's forecast to be what they think they're going to do, and I'd like the manager's forecast to be what they think the sum of their reps will do. But at some companies, managers kind of muscle reps. Yeah.
So for me as a sales manager, I should say to my team of reps, go away, look at the accounts that we have, look at pipe, and come back to me with targets? How should we approach
a forecast every week? Basically, that's what I would say. Every Sunday night, I want you to put into a Google Sheet or in the CRM system your forecast for the quarter. I want to watch how that number changes over time, and I want it to be your forecast for the quarter. Is the main point, Harry.
What does a good forecast look like, and what does a bad one look like?
So as soon as you do this weekly approach, you now get to look at the shape of the curve. And a good forecast looks like this, gently upsloping to the actual number you sell. Notice I never talked about quota, because forecast is not about quota. That eventual what you sold may be well above your quota, it may be well above your quota, but you didn't ask what a good sales performance was, you asked what a good forecast was. And a good forecast is gently upsloping, landing at the number that you actually sell. Because that means I'm not misleading my boss, and in aggregate, we're not misleading the company about how much we're going to sell. We're always slightly lowballing it, right? If it's super lowball, it's very hard to run the business. The more common problem, if it's super optimistic, where I'm going to sell $1 million, just kidding, I sold 300K, right? It's impossible to run the business.
Should forecasts always be slightly unachievable? Should you always be 70% of the way there, 80%, but never quite there? How do you approach that?
So a forecast, in my mind, it's a very important point because it relates to the other thing I said. A forecast, in my mind, is your prediction as to what you're going to sell for the quarter, period. Some sales managers, here's the thing that I think is the worst thing ever for forecasting. Harry, how much are you going to sell? You go, 100. I go, come on, Harry, you can sell 120. What about the Jones deal? 120. You can do 120. Step up, man up. Come on, Harry. And you say, okay, I can sell 120, right? They say, okay, I'm going to write down 120 for your forecast, right? That 120 is a useless number for predicting the business, right? And this is where some sales managers use the forecast as a club to kind of push the reps around. Like if I could just in a moment of weakness get you commit to 120, then I can hold it against you for the rest of the quarter. First, I don't think that's great sales management, but you have other guests you can interview about that. I know it's bad forecasting. I don't want that 120 number. I want to know the 100 number because that's what you thought you could sell before you were twisted.
Do you not think you're just getting the best out of the reps by pushing them? Like everyone has a stretch.
There's a lot of talk about that. I've worked for bosses and very successful people who think you always keep the carrot, in front of the donkey, right? So you're never happy. You're always wanting a little bit more. Personally, as you know, Harry, I grew up in enterprise software. I started at the bottom. I think it's a terrible way to be managed. So I've never wanted to manage people that way because basically you're constantly failing, right? So in particularly for forecasting, it's no way to forecast. So all I'm saying is when you make your forecast, just write down what you think you're going to sell. And then I can have a different conversation about, Harry, why can't you sell more? I think you can sell, but it's not about your forecast. That's already been sent off to finance.
That's motivation from a leader or someone higher than you in the chain, so to speak. A lot of people say that you should hire reps 2 at a time so that they kind of have a Hunger Games to compete, so to speak. Do you agree with hiring reps 2 at a time, especially in the early days? Or actually, do you feel that it's overhyped?
So I like hiring 3 at a time, but not for the Hunger Games effect, for the controlled experiment effect. Because if I think a rep of a certain profile, with a certain background, right? So you worked at Salesforce for 5 years, you've sold CRM, you've done deals in 50 to 100K, and you've sold to Fortune 500 companies. If I think that profile is the one that's going to work for me, selling to banks in New York, I'd like to hire 3 of them. Why? Because I want a good experiment. Because if I hire 1 and they fail, what do I know? Maybe I got an outlier. Maybe I got a clown, right? If I'm trying to grow a business, I would say your job in the early days is to run good experiments. And it means if it works, we know what to replicate. And if it fails, we know what not to do. And when you hire modulo 1, you don't get that. Even modulo 2, you don't get. If I hire 3 of them and they all look really good on paper and they had that profile and all 3 fail, I'm pretty like, let's not do that again. And conversely, if it works really well, like, hey, let's go get 6 more. Let's get 9 more.
Dave, how fast do you know if a rep's not good?
Yeah, that's a really hard question. I would say somewhere between 6 and 12 months in enterprise.
Whoa, that long?
Well, in enterprise, I did say, because you got 6 to 9 month sales cycles, so it's hard.
But that's on converted sales. Like a month in, you can be like, hey, show me what you've got, and you can go, that pipe is not great. The number of calls that you've had in the last week is not great. The cool notes are not great.
Got it. Yeah. I guess the word that got me was no. Because I only know once I've seen what they've done. I can guess, I can have a feeling about it.
Do you not think you know from the cool notes, from looking at pipe, from looking at how they spend their time?
Look, if I wanted an indicator, let me answer the question constructively. I'd listen to call recordings or go on calls with them. That's a very important data point, and you can tell pretty quickly if you think this person's doing the right thing. And as usual, I'm going to give you the opposite case, Harry. The hardest case is not firing somebody who's not selling. That's easy. The hardest case is keeping somebody who's not selling. And if you haven't listened to calls, you can't do that. But look, I'll give you a concrete example. At MarkLogic, we sold most of our sales in 2 verticals, media and government. But I had reps outside those verticals. That was a hard slog. You had no support from the company, no reference customers. I could have fired every one of those reps and we never would have sold anything because they couldn't sell anything, right? So every year I had to look at it and go, Mike, I've listened to your calls. I've been on calls with you. I think you're doing the right stuff. And you came in at 80% or 70%. I might even give you extra money to keep you around because you're doing the right things. And I know you're doing the right things because I'm close enough to you to know that. So that's the hardest case. And that's 0 to 1. You got to do that, Harry. It's any clown can fire. At a big company, you have 100 reps and you got to fire the bottom 20%. That's easy. What's hard is knowing when you have 3 reps, who do you keep and who do you fire? And when no one's selling.
Okay, so we do the call recordings. That's one way of like reviewing. When we think about like sales reviews, how often we're an early stage company, and when we think about the audience, it's mostly 100K ARR to 10 million ARR, because not actually many companies beat the 10 million ARR. When we think about that as a range, how often should the CEO/sales leader be doing sales reviews?
In my world, there's 3 different types of calls. So let me just define what I think the calls are. There's a forecast call, there's a pipeline scrub, and there's a deal review. Purpose of forecast calls, come up with the forecast, should be all numbers. One of my sides to fire as sales manager is a forecast call. It's all storytelling. Oh, I talked to Joe, and Joe talked to Mary, and Mary said this, but I didn't ask you that. I asked how much you're going to sell this quarter, right? So that's forecast call. Pipeline scrub is all about scrubbing the 4 key value fields of an opportunity: value, close date, stage, and forecast category. Right. So let's validate those are real data. And then a deal review is to me a very collaborative exercise where we get as many people who want to come, and we say, if you're the rep, Harry, how are we going to help Harry win this deal? Harry, tell us everything about this deal and let's help you win. So I don't, when you say sales review, I'm not sure what you mean. If it's one of those 3 things, I can talk. Otherwise, you got to define it for me.
I would say a sales review in terms of the third and final one.
So, because to me, a lot of people use sales review as a scary, mean thing. And that's why I like my framing of it. It's not scary at all. We're trying to help you win. So tell us everything. It's your peers, it's your bosses, it's the CEO. And by the way, if you're talking about, because you mentioned some pretty big deal sizes there, Harry. And if you're a small company doing $500K or $1 million deals, at MarkLogic, we did those. I would always think, how could I ever explain to the boss, the board, if I wasn't in the $1 million deal, right? If we had a $5 or $10 million quarter and there's $1 million or $2 million deal, and the board says, what went wrong? And I say, I don't know. You need to ask Joe, right? That's a terrible answer. So as a CEO founder, I think you just need to look at the materiality of the deal to the quarter. And like, are you, what's the word, with negligence in your duties? Like at some level, if the deal is material in the quarter, you better be in it deep. And that's not just a deal review. That's meeting the customer. Have you flown out, talked to them? Do you know the names of the people? Because that's what it is to do big deals.
You know, I sit in many board meetings, and often they have the heads of sales there, and we say, well, why did we miss numbers? And they go, the Jones account, it just slipped into next quarter it slipped. And I'm kind of left there going, okay, what do I say to that? Like, what's a good reason to let an account slip into next quarter versus not?
I think there are almost 2 types of companies, those where slip is an acceptable thing and those that aren't. Because at some level, I mean, let me just be a jerk for a minute. Okay, wait a minute. You don't make the software, so your only job is to sell the software. You're not a technical resource. You don't help customers deploy. So this is kind of the you had one job argument, right? Like, you had one job. And it's like, let's just remember, that's what you do in sales. So I'm not super sympathetic to slipping, right? And as part of your one job, you're supposed to tell me how much you're going to sell and when. And so I start with a pretty hard position. Let me just go in order. That's the first thing, which is my philosophy is not, slips happen, inevitable. No, it's your job is for not to be having this conversation. So I'm immediately unhappy. The next question is, how much slipped into this quarter? Because people love to be asymmetric. They love to say, oh, yeah, we made the quarter except for this deal that slipped out. I'm like, well, that's funny because $2 million slipped in that should have been made last quarter. So if we're going to do this slipping game, let's do it in a symmetric manner, because I've noticed your tendency is to only want to kind of artificially pull things in, like count the first week of next quarter, week 14 of the quarter, or as I say, day 366 of the year, right? No, that doesn't happen. The last point I'd say on slips is that on a given deal, I'd ask why. And for me, let me give you an example of an invalid excuse and a valid excuse. Invalid. The purchasing agent was on vacation. Well, gosh, nobody could have known that was going to happen. Like, we could not have called. Like, I make a thing called the close plan, and that's actually one of the questions. Who is going to sign the document? Whose name is going to be on the ink on the document? And are they around that week? Right. And you can make a list of those questions. By the way, everyone should have a closed plan. Every time you hear one of those excuses, it should go on to the closed plan. His uncle in Toledo got married, didn't know, or whatever it is. But we're never going to let this happen again. So your job is to get the paperwork by midnight on the last day of the quarter. And so anything about we didn't know this or we didn't know that, or another popular one, the last minute there was a committee that needed to approve it. You had one job. Your job was to know about the existence of that committee. Did you ask the buyer if they'd ever done a deal of this size? Well, I asked them if they did a deal before. The biggest deal they did was $200K. Ours was $500K. That required an extra level of approval they didn't know about. Your job was to know that, right? Put that question in the close plan to make sure we never get bit by that again. So in general, I'm pretty unsympathetic, Harry.
The thing I love about our conversations is you just say so many things where I'm like, I can just go in so many different ways with this. The close plan, I don't hear people talk about that often, Dave. I interview lots of sales leaders. When should we create a close plan? Should when's the right time? What are the standard steps? Are they standard? And how do you think about good versus bad close plan?
So to me, the close plan is in some ways, it's the anti-slip plan, right? It's the list of things we need to know to make sure we can close the deal this month. So it's not strategic. And in my mind, it's a list of answers to questions like, what day is the deal going to close? Who's going to close it? What committee needs to approve it? Do they have budget authority? What's the do we understand the process for getting a budget authority? Like, to a certain extent, just think of the close plan as a list of questions that over time you build every time a deal slips, and that you could have known about. Like, by the way, I should give you, to be nice, I'll give you a valid difference. The company got acquired on the last day of the quarter. All purchasing got frozen. Okay, right? That we couldn't have seen coming, right? But it needs to literally be that level of act of God, right, before it's an excusable reason for a slip. But back to the close plan, I can go dig one up and share it with you later. But it's just literally all the stuff that can go wrong it's super mechanical. Like,
can I ask, have you ever shared one publicly before?
Never. No, I've not.
Would you do it with the show?
I could clean one up. Yeah, it would take me half an hour, but I'll go anonymize it. I actually consider you a real one from 2005 or something.
I think it would be a phenomenal resource that so many sales teams would love in terms of a template of like, actually, what are those questions? Because a closed plan that misses two of the questions that you think are crucial is useless, because then they could be one of the two and the closed plan doesn't work. So I'd love that. And I think so many people would. So that'd be fantastic. Is that okay?
Yeah, absolutely.
So that's like crucial. How do you think about buyers exaggerating? And what I mean by that is every buyer says, "Oh, I'm the buyer." Yeah, you're speaking to the buyer. How do you know if you're really speaking to a buyer, Dave?
I'm a big believer in a semi-obscure sales methodology called selling through curiosity by Barry Ryan. And the whole first principle of selling through curiosity is just, I'm curious. So my answer to that, I'm curious, Harry, who else so I understand you're the buyer, Harry. Who else might be involved in this process? I'm curious, Harry, whose budget is this going to be coming from? I'm curious, Harry, have you guys ever spent this much budget before in this kind of system? I'm curious, aren't there other people? Who else is impacted by this decision? Don't they get a vote, Harry? Can you just explain this to me? And by the way, the last time you did this kind of process, can you tell me what went down and how it worked and what the timing was? Selling through curiosity is just amazing, because most salespeople are, in some ways, they're too busy trying to prove how smart they are, be tough and confident. And it's just so humble a place to come from, which is, Harry, I'm really curious, have you done this before? And I'm not saying, Harry, you're not the buyer. Come on, they're not going to let you spend $150,000. No. It's going to be more.
You're a moron. Why would they give you a checkbook? That'd be hilarious. It's an interesting reverse sales tactic, isn't it?
Absolutely.
That's hilarious. No, I love that. In terms of getting to that close, we get to the close, and then they go, Dave, the price is just quite high, and we're looking at other options as well. Can you give me a 25% discount? My question to you, how do you think about discounting today in 2024? Because it does depend on macro, I think. How do you think about discounting today, and how do you advise sales teams on the best way to approach it?
Because some of these situations, it's best not to get into them in the first place, and second, it's best to come armed. So a lot of the valid argument for value selling, I thought we agreed that the system was going to save you $5 million a quarter. Why are you coming to me for a $100K discount on the last day of the deal?
I get you, but I've got two other options, and they're offering it to me at that, and so I just have to make the business decision.
Got it. So there's going to be a series of fallback strategies here, Harry. None of them is going to work, but what I'm trying to do is make sure at least I have cards to play. The next card I would play is, so the first card I'd play is value. Harry, this potentially delays the deal because I need to go get approval on my end. So this could push it back a month or two. I'm not sure we can do it. And if we do, you're still going to lose a month or two of benefits. That's going to cost you more than the discount right there. So that's the first card I play, which is the risk of delay and value. The next card I'd play would be the wholesale. If you're managing the sales cycle as a series of give-gets, which you should be. So, Carrie, we talked about this. We talked about pricing before when we cut it the last time, right? Remember, we had a negotiation. We took it down from $2 million to 1.8. I said, you may recall this. I said, I can get you 1.8 if you can commit to me that we would do this deal, and you committed to me to do this deal, right? So that'll be the next card I'd play, right? Like, hey, we had this conversation already. You're effectively using the last negotiation as a starting point for a new round of negotiation. And I'm calling foul, and I was saying the company may not do it, my boss may not let me do it, but I could try, right? Because somewhat as a seller, you need to kind of play powerless as well. Because I'm kind of your advocate too. So I can try. I'm really disappointed because, my boss is going to kill me because when I came down from 2 to 1.8, you promised me you could get this deal done. And you might just say, I can't. I literally can't. The competitor's in at 1.7 and they're going to buy that. So then I have to take it back to the company. I mean, at some point I'm going to play these cards. They may not work. The most common in my experience was competitors because I tended to work in competitive spaces. And then you have to take it back to the VP of sales and say, how many times have they done this? Do we believe them? If I cut it to 1.8, are they going to come back and ask for 1.6 and on, 8 hours later? Like, how are we going to get this deal done? Like, how can I trust your word anymore? So it's hard, Harry, but most of the great salespeople I know will try very hard not to collapse. They're not going to be scared. Like, oh my God, we can get it at 1.7 and instantly cave because I'm signaling to you that why not ask for 1.6? There's a great metaphor, Harry, which is when do you stop squeezing a rag? When the water stops coming out, right? So as long as there's water coming out, I'm going to keep squeezing. And then even then, when the water stops coming out, what do? One last twist. Right. So you got to imagine yourself on the receiving end, right? You're the wet rag and they're squeezing you, water's coming out, and then you're going to get one more. And you got to say no, because otherwise you're going to keep squeezing.
Dave, we could maybe move to 1.6, but you are a great brand logo customer. I need your logo on the website and I need a customer reference. How important are customer references? And are sales teams right to place a lot of weight and give for them?
So I think they're important, and I think a good customer will do one anyway. So I don't love it as a negotiating chip because if I'm doing right by your business and if I'm delivering value and if we have a good relationship, you should do it anyway. And if you're only doing it because I have a gun to your head because you promised you'd do one, then I'm not sure how good a reference you're going to be anyway. So I don't love it. I think you do that as a last resort to try and maintain some shred of quid pro quo. that I have to ask for something, but in reality, it's not me. You should build a customer reference program.
Okay, so this customer actually they wouldn't pay, and they decided to go elsewhere. We need to go outbound again, Dave. Yeah. You said before that outbound, many found coal in their outbound stocking. I saw this and I just loved it. What did you mean by many found coal in their outbound stocking?
Because I guess I wrote that around Christmas. I think I was in the mood. I think for a lot of people, outbound was this kind of great savior. That when they found, we talked earlier about the low-hanging fruit problem, and they went, oh gosh, we've picked all the low-hanging fruit, and we could possibly improve execution over there because I'll have to start questioning my people because they're telling me it's all picked. So I guess the only thing I can do is outbound. And at least I can be in control of my destiny, and I can give the salespeople something to do when they don't have enough leads, and I can quiet all the salespeople barking at me for not getting enough opportunities for marketing. So I don't know exactly what causes kind of outbound fever, Harry, but and I'm a big believer in outbound in the right circumstance, right? Typically ABM, very targeted account selling, big deals. Outbound is a wonderful part of the strategy. But I'm not a believer in, we can't generate enough inbound and we don't know what to do, so let's do outbound. So we're just going to call random people. Like, we don't have a targeted account strategy. So we're just going to call a lot of people and try and make them show up to meetings, and we think that's going to convert better than just getting more content out there that makes them interested in us and come to our events and download our white papers? Maybe we could try it, but
as a VC, can I offer an alternative suggestion, which is we saw the proliferation of outbound tools and the sophistication of outbound tools, which many bought, and then they're put on sales teams as like, hey, we're now using this outbound tool, which helps you craft the perfect email for outbound targets. Yeah. And I would be interested to see the correlation between the buying of outbound tooling and the proliferation of outbound activity.
Well, it's the other problem, Harry, is it's an arms race, which is now everybody has that tool and everybody has the perfect email, so the buyer becomes numb to it. I think outbound actually worked better 4 years ago than it does today, because I think everyone's doing it and people are getting flooded with it, and they don't like getting called on their cell phone. They're not answering their regular phone, and you can do email sequences, but they're covered in email, and I think there's new spam rules going into effect, but maybe they're not going to happen. I'm not sure. I just think everything about outbound is inherently difficult and going to get harder. So hey, look, Harry, I'm a marketing person by background, but by the way, the point of that statement was I actually literally saw that happen. I saw CEOs who 2 years ago were telling me outbound is the big savior, and I'm like, are you sure? And now they're back at me going, forget outbound. I thought it was going to save everything, and it didn't. And the answer is yeah.
Is there any point in investing in outbound? If you can invest in great content marketing, is there any point in investing in outbound?
Yeah, if you know, put it this way, if the juice is worth the squeeze, as I say, because good outbound is expensive. You're going to spend a lot of money kind of stalking a company. Let's just say, for example, I'm an early stage startup. I've sold 2 big insurance companies, and there's 10 more that I think need me. Stalk the heck out of them, right? You're doing big deals. It's got to be worth it. So you get an outbound SDR, you get a sales rep, you get marketing, you do retargeting, and you stalk these customers. Literally, like, you don't know it yet, but we're your destiny, right? So, and like, you're gonna buy from me. That can work very well because you're replicating a use case in an industry. Right, you've got good reason to believe that these people need your software and they don't know it yet. I'm all in favor of targeted marketing in that case, because it's a big deal. If you're selling a $5,000 a year system to anybody as a generic productivity tool, I have a lot more trouble getting excited about outbound.
Where does it make sense and where does it not? Is it like when you cross the 100,000 ACV and you have a very limited number of buyers? Is that the differentiation?
Yeah, or you've deliberately limited the number of buyers because you're going to do a vertical expansion strategy. So let's just say, right, because your tool might be sellable to everybody, but let's just say you've got some traction in insurance and you want to go replicate within insurance, then I'd go do it. And it's not to say the product is only useful in insurance, but I'm deliberately going to constrain my go-to-market strategy so I have useful references. Right? I mean, I can summarize all of Jeffrey Moore in one sentence, which is people buy when they think people like them use your solution, period. Do people like me use your solution? And I get to decide what's like me. So the question is, what's like me, right? And it means my industry, my use case, my problem, my size, right? So much of sales is, can I prove that people like you have bought this and it helped them? So, and the problem with sales reps is they're very quick to say, oh, you both breathe oxygen, therefore you're like each other, right? It's like, I have nothing in common with this person whatsoever, right? The customer gets to define who's like them.
If you're a sales rep, how do you prove that people like you, Dave, use and love my product? Customer references, logos, name dropping. Oh, well, I was talking to X the other day.
Look, vertical strategies work because of the people like me effect. They're inherently limited and they're a little bit high cost because you now have to learn a lot about all your customers in that industry. But I think all of the above, name dropping, say, did you know the company X and company Y uses us? They're leaders in your space. Demonstrating understanding the use case. What's it? Is it when Harry meets Sally when they're completing each other's sentences, right? No, that was Jerry Maguire. Like when you're describing your problem and I can finish your sentence, that builds credibility. It's like, whoa, this guy actually understands my problem. He's completed my sentences. And he says they're using me at the competitors down the street, and the SC just helped implement a system at one of those competitors, right? It's that whole effect of, oh my gosh, people like me. And by the way, a vertical dinner, right? So you get invited to a dinner and you find literally people like you there. Yeah, it's very important.
So verticalized product marketing, it's kind of easier. You have a very specific industry you're targeting. They tend to have the same pains. Tend to have the same data in many respects. Great. Much harder when it's horizontal to do effective product marketing. When you're Notion or Airtable, you're selling to developers and also to mothers and dentists and everyone in between. I love that everyone always uses dentists as the random analogy. It was a weird one, isn't it? Why dentists? But you said before, and so that's like a freaking hard product marketing challenge. And you said before, product marketing take a back seat. I was intrigued what you meant by product marketing take a back seat.
Use case is the answer. So I have 3 layers I can fall back to, right? I can say, hey, Harry, people like you use this, and they're like you in every way, right? They're in your vertical, they're in they're solving your problem, they're in your size range. The next level is just use case, where I need to convince you that your use case is similar to someone else's use case. That this case, that people like you, are people who have this task management problem. Or I'll give you a real example. For me, one of the stranger ones I had to try and convince JetBlue Airlines that they were like McGraw-Hill publishers, right? As well, when we fly planes, they sell books. Like, this is not going to be easy, right? And I said, well, what's your problem with JetBlue? And they're like, well, every plane is different, and therefore the documentation for every plane is different. And the plane can't leave the gates without a custom piece of documentation for that specific plane. And even if we change the coffee pot in a maintenance operation, I can't fly the plane unless the chapter on how to fix the coffee pot is changed. So every document is unique. And I said, tell me if I'm wrong here, but it sounds to me that it's a lot like what we do with McGraw-Hill, because they sell educational textbooks, and evolution in California is a theory, whereas in Kansas, it's actually just a hypothesis. It's been downgraded. Some people think. So therefore, in order for them to sell a book, or if they want to talk about Native American tribes, they need to use the local tribe in Oklahoma versus the one in California for the sidebars. So every textbook, if you want to sell textbooks in any state in the United States, the book needs to be customized. I think that problem sounds similar to you, right? And that's how we sold that use case. Got $1 million deal by different industry, same problem. And the issue is you kind of need to lead the horse to water there, because it doesn't matter if I think it's the same problem, they need to think it's the same problem.
I love that. And I think that's a very smart alignment. It's a challenge. What do you advise founders, though? Because I think the biggest problem I see, honestly, Dave, with early stage founders is as launch day comes, they broaden the ICP in fear that they're not going to get anyone use their product. And so they go, we're not just actually for product managers now. We're for anyone who needs a to-do list or whatever that is. In terms of like the biggest product marketing mistakes that founders and early product people make, what are they that you see most often?
So there's a lot in that question. I want to tell you a story first. You may have to re-ask it and edit it out, but I got to tell you a story first. So I worked at an object database company, Harry, and object databases was a grim space back in the day. It was right after the relational database. Everybody thought they'd be the second coming. So there was a whole generation of companies, raised about $100 billion in aggregate, which is a lot of money at the time. Everyone tried to sell this stuff horizontally. And I joined, I'm running product marketing, and it doesn't work. Nobody wants to buy them because they're just learning how to adopt relational databases. So one day I come to work and they literally fire the entire executive team. And I get my first VP of marketing job, battlefield promotion to VP of marketing. And they bring in a new CEO and we say, you know what, let's focus on what's working. Let's double down on what's working. And he said, Dave, Larry, you guys go figure out what's working. So me and Larry went off and we came back and we said, well, we're only a $5 million company, so there's not a lot working here, but we think telecommunications network management and this new standard is working. He says, great, let's bet everything on that. All chips on telecom network management. And we grew that business from, say, two of the 5 to 15 over the next 2 years. And back in those days, the company could go public at 30. So they actually went public at 30 off that strategy. But as they're getting ready for the IPO, I'll never forget this, because the 2 reasons I went to Business Objects. One was I was very attracted by moving to France, loved the founders, loved the space. The other was I had watched Versant fail trying to be everything to everybody, succeed with this razor-sharp focus as we approached the $30 million IPO. No, we got to broaden. So now it's good for finance, it's good for healthcare, it's good for telecom. And they literally went public at $6 a share. It stayed at $6 a share, fell down to $3, and then kind of went out of business or got acquired. So I literally watched the whole life cycle of no focus driving nothing, intense focus driving success, and then the financial types coming in and saying, this won't sell on Wall Street with no regard for the marketplace, right? So the short answer to your question is external pressure driven with good intent by people who don't understand the business. That's the biggest risk.
I think what I see also is like a need to meet valuations that were 2021 valuations. And the only way to do that is to expand into verticals or use cases that are not aligned, not beneficial, but do we need to?
Yeah, and those hops are dangerous, Harry. The other thing, so I imagine this all as a matrix of vertical versus use case. And every time you're hopping a cell, it's danger, right? Like you know how to sell the custom publishing use case to publishers. Can I sell it to airlines? The first one is really, really hard, right? And once you've got one, then you can start to replicate. But anytime you're hopping in this matrix, you should put a big, like, yellow, this is going to be difficult flag. And if you think you can just kind of knock these things down like dominoes, no way.
I love that. No, I totally get you. I find we hail engineering founders today, Dave. And, engineers are great, no disrespect to them. But with that praise or idolization, we denigrate GTM focused founders in some way less pure. How do you think about that? And what do you think they most often do not understand?
I'm a tough person to answer this question because I view my personal specialty as working with technical founders to explain sales and marketing. Like, that's my superpower. So my favorite thing to do is take, a PhD dropout or PhD student who's founded a business and try and help them understand.
Do you find they respect it? I find most often they're like, sales and marketing, fluff.
Well, because I think most people do a terrible job of explaining it. So that is the typical reaction, but I don't blame the founder. I blame the explainer. This is actually what I think I'm good at, Harry. We've hit the one superpower I think I have. I think I'm really good at explaining that. And what I find is that they're really good. Turns out PhDs are really good students. And if they think you're credible and you could teach them something, they learn incredibly fast and they're super interested. You try to feed them bullshit? No. They're not interested, right? Or you just say, well, it worked at Cisco or worked at Salesforce or worked at wherever. That doesn't work for them. But if you could structure it and explain it, I find in general they're phenomenally good to work with.
Do you think we denigrate GTM focused founders?
I don't actually know. I would say the fashion right now is product oriented founders for sure. I would say product, not engineering, by the way. That seems to be the best. Like if I was advising a young person where to go if you wanted to found a company in 2 or 3 years, I'd say product, not engineering. Back in the day, it really was engineering because I think product is seen as a kind of less intense form of engineering. Like they're technical enough, they understand the product. Like, do you really have to understand exactly how to build a product? So I don't know. I think that's my perception of the preference of the industry right now. Because back in the day, it really was engineering. I mean, they were engineers. They weren't product people because some product people aren't that technical, which creates its own set of problems, right? Because they're neither fish nor fowl. I think GTM founders are revered if they're selling GTM tech. So I think that's the case where people want them, right? Because they understand the buyer and the problem. I think the other interesting pattern to look at, and I don't have data here, but my sense is if and when you replace a founder, which was extremely unpopular for the last 5 years, but I think will get more popular going forward, you will tend to replace them with a GTM person. That has always been the pattern in Silicon Valley. That you replace product and engineering oriented founders with GTM oriented people. And Andreessen Horowitz, in my opinion, put that trend on hold for a decade or more, right? But I can tell you back when I was a CEO, if you went to Bucks in Woodside or had lunch on Sand Hill Road, you'd hear founder issues. We got to replace the founder. There's a sell-by date on the founder's head. And like replacing founders was like super common in those days. And then Andreessen came along and said, no, and the whole industry kind of followed suit. They were very, very founder friendly.
Why do you think that pendulum will swing back and we'll see replacing founders returning more commonly?
Because I think like any extreme, it's wrong. And I think we were too far the other way before. We were too quick to throw out founders. I personally think a founder is the best person to run the business. I am super founder friendly, but no, they're not. I used to say they had a invisibility cloak. That literally, you see like a founder could do anything. Part of it was jealousy because I was a non-founder CEO and I watched my back every day because I knew they could fire me and would. Whereas some founders just act like, and sometimes by contractual terms they are, but they act unfireable. And I think it's not good. None of us should feel like we're invincible.
I would also say that replacing a founder does not mean like removing them from the company. I still see incredible value from having them in a role where they can empower teams, empower customers, tell the vision. But bluntly, CEOs know how to make money printing machines. I think of, MongoDB with Dev. Dev is a phenomenal CEO. Very, very few founders are as good a CEO as Dev is. And it takes a very different CEO to run a public company than to scale to $1 million in ARR. You can still have them in the company, but they're just not the CEO and leader.
Agreed, by the way, and that was always my position, and that's what I did at MarkLogic, by the way. There were 2 PhD founders who founded it. I viewed myself as their Sherpa. I was going to get you to the top of the mountain, right? Because I like technical founders. I know what I'm good at and what I'm not good at, especially when you're selling platform software. You need these geniuses driving the vision and the product. So totally agree with you, Harry. That replacing the founder as CEO doesn't have to mean, if ego doesn't get in the way and if things are properly handled, it doesn't have to mean they're not at the company anymore. They can be in a very important role. So but basically, I just think the pendulum swung too far. I think we're too quick to replace them in the 90s and early 2000s. I think for the last, 15 years, we've been too many lives. Just too many, cat has 9 lives. It's like, wow, founders just have unlimited lives. They can make as many mistakes as they want to, and at some point you need to replace them. I just think we're swinging back to a more reasonable middle ground.
I think we definitely are. I do want to touch on sales tooling and AI before we move into a quick fire. We've seen this explosion of AI sales tools. How do you advise SaaS founders who are sitting looking at this landscape going, what do I do? How do you think they should approach it?
Yeah, play with stuff. That's what I think. I mean, if you're a vendor, in my mind, get out there and know you're playing musical chairs, and when the music stops, you're either going to be a player or not. So if I were a founder of one of these companies, I'd be very aggressive right now to get myself known and established in the market, because this market will organize, right? We're in the chaos phase of the market. And so from the vendor side, this will organize. There will be winners and losers, and it will happen overnight, 18 months from now.
Do you think it will, or do you think it'll be baked into existing vendors? Will outreach just add
that's
it?
Part of the, I'd include that in market organizing. Yeah, it might be done through M&A. It might be through turning companies into features. There's a lot of ways the market can organize. The thing I know is that it's not going to be 100 different companies with too many names, and we can't understand who does what. But my advice is, rather than try to pick winners, I mean, VCs have that problem. Customers can just play with tools, right? And just go get yourself familiar with these things. That's what I advise people. Yeah, try to pick the tool you think is going to win, so you don't have to switch later. But more important than that, don't sit on the sideline waiting for a winner to emerge before you figure out how this tool can help your business, right? Just go play. Tell your sales ops head, I want 30% of your time playing with new tools. Just go out and try new stuff. Right? Because we need to understand what these things are and how they can help us, because they can make phenomenal improvements in productivity.
How much of an impact do you think AI tooling will impact sales in SaaS over the next 5 years?
Well, Battery came up with a famous slide, now famous slide, where they basically said, I'm going to get I think to support 30 sellers, they argued that today it takes a 110-person organization and that tomorrow it'll take 75. So they're saying for the same quota, for the same number of quota-carrying AEs, you can cut the org from 110 to 75. So it's on the order of a 30% cut. So, and I don't think that's necessarily wrong. So they're saying the AI transformation of sales will be a 30% increase.
Is there anything that you think people misunderstand or don't appreciate when applying AI and the new AI sales tooling to SaaS?
I don't, Harry, because I think there's an enormous amount of drudgery in sales. And I just think this stuff's going to eliminate drudgery. I don't think it's going to eliminate quality work. It's going to eliminate drudgery.
Is outbound going to become more or less important in an AI world?
I can be too quick on these things, Harry, but I think it's going to saturate. Once everybody has great outbound tools, once I'm getting 50 ultra personalized emails a day, I'm going to ignore them all. I mean, I just think it's a transient advantage. And that's why I come back to inbound. So go use it, right? Transient advantage is still an advantage, right? So go use it while it's there, but don't rely on it as your strategy, because a year from now, all your competitors are going to have these tools.
Dave, I would love to dive into a quick fire round. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
Sounds dangerous, Harry.
It's very, very dangerous. So what worries you most in SaaS today?
Subscription pricing.
Why?
Because I think it's a religion, and religions scare me. I mean, I think there's time and a place for it. I think we're now past the peak on it, But I get nervous whenever VCs show up to CEOs and say, do this. Everyone's doing it. It's the future. And if there's no underlying real reason other than everyone's doing it, I don't know if VCs know how distracting they can be to CEOs. Because I listen. When I was a CEO, I listened. My VCs told me to do something, I'd do it. And you have to understand there's an opportunity cost of me looking at it, building a model, trying to make a model that's some hybrid. So just, I don't know, be careful what you ask for. And I just worry that subscription pricing during the ZIRP days was the greatest thing in the world because the money was flowing and everybody was expanding. And now the tide's going out, to mix metaphors, and we're seeing the downside of it. And by the way, the great paradox right now is the people who are in subscription pricing generally have been hit harder than those who are not, but they're nevertheless still growing faster. So let that little brain twister on.
What's the biggest mistake founders make when expanding into enterprise?
Product. They think that the product will work in enterprise without understanding the requirements. In enterprise is, well, what's the expression? The big company is not a large, small company, right?
I've never heard that before. I like that.
It's a great one.
What would you say is the biggest mistake founders make when hiring sales teams?
Hiring a VP on pedigree value who turns out just to have been in the right place at the right time.
How do you know if they're right place, right time? Sometimes attribution is not even reliable in the way that, like, the person who sold Uber's the Uber account at Twilio, it was like an entry-level sell. They probably just monitored it and then turned into a monster account. Yeah,
we had at Mark Logic, this is way back in the day, but we had one rep had one of the house accounts, and most of the people in the company really didn't like working with that rep and thought he was kind of semi-incompetent, kind of bumbling. And the board was like, we need more Schmedleys. Schmedley's amazing. Because if you just look at the numbers, Schmedley was amazing. Whereas most of the people who had to drive it was just like, oh my God, Schmedley's kind of a pain in the neck. But so much as I love numbers, you need to look beyond them. I think if you ask why questions about how decisions got made, you tend to find out if they were making them.
What will be the biggest challenge faced by SaaS companies in 2024?
Efficient growth. We learned how to do inefficient growth really well in the last 4 years.
How good do you think sales teams really are today? When I hear you talk about your closed plans, when I hear you talk about forecasting, I'm like, Dave, you sound great. I know a lot of sales teams, they don't sound like you, my friend. How good do you think the caliber of sales talent we have today is?
I think it's good. I don't have any reason to believe it's changed. I think we're, over time, giving them better systems and processes. So I'm a believer in sales talent. I don't think talent's the problem.
What in SaaS would you most like to change? If you could change one thing in the world of SaaS, what would you most like to change?
I think it's already changed, which is the funding environment. I honestly don't believe that foie gras startups, as they say, stuffing them full of cash is a healthy behavior. Some are actually good. I know a few that seem good at raising money and not spending it and saving it to grow later, right? But most people, when you stuff them full of money, they go spend it. And it's a shame. So I'd like the funding environment to change because I don't actually think it's been healthy.
Well, do not worry, my friend. I think that's changed. But listen, Dave, I love it with you because, as I said, I always listen to you and then I have 10 subsequent questions, as you can see from my arm.
Okay.
But Dave, I've loved this. So thank you so much for joining me.
Well, thank you, Harry. I'm glad I passed the arm test. Though I was worried your arm would be clean at the end.